But generally speaking, very, very surprising just how bearish everybody was. I think the wealthy people, the big time players, the $100 million a year acquirers, almost universally bearish. I am driving back right now from the airport. I was just in Los Angeles for the Reconvene conference hosted by Moses Kagan. It was in Santa Monica. It was about 240 or 280 real estate professionals, mostly from Twitter, gathering to enjoy some great programming, meaning interviews from top people in the field, and also a lot of just conversation and candid discussion about the market and where we are. My main takeaways, I'll do my best to stay organized in this email. I haven't had a chance, or in this podcast, I haven't had a chance to really fully, come down and think about and organize my thoughts. But I think the overwhelming atmosphere was much different than last year. I went to the conference in 2021. I was a speaker at the conference, and it seemed like institutional multifamily folks were really struggling at that time to find deals. Their cap rates were compressed, but the storage folks were still buying. Industrial was having a heyday. Everybody was very bullish. Interest rates were 3.5% for commercial loans. So last year, everybody was bullish, very joyous atmosphere. The day before the conference this year, Wednesday, was the Fed meeting, and Jerome Powell dropped a bomb on the markets again, another 75 basis points, and also just a lot of very dark commentary about how he needs to see employment numbers get worse and housing data to get worse before they'll consider tapering interest rates. And if you're wondering why interest rates are the world right now and why everybody's talking about interest rates right now, there's a really good video on YouTube called The Economic Machine by Ray Dalio. If you watch that, it's 30 minutes. It explains to you how leverage and borrowing money and the cheapness of money keeps asset prices high. And you go through, when interest rates rise, like they're rising now, you go through delevering, which means pain and suffering and asset values dipping significantly as debt gets more expensive. So I highly recommend you checking that out. If you've been in the real estate game, it's no surprise if that interest rates drastically and directly impact the value of an asset, because if we buy a piece of property, anywhere from 50 to 80% of the money put up to buy that property is going to be bank debt. If that bank debt is cheap, you can pay more because you have to spend less money servicing that debt. And if bank debt is expensive, you're only able to pay less because you have to spend less, more and more money servicing that debt. So here I am on the way back from what turned into a serious pity party among the real estate professionals. I think most of them, I talked to probably 100 people over 3 days. I had a conversation with 100 different people. 80% of them were bearish, very negative, not buying, risk off. I'd say 20% were either neutral or bullish, and most of them were operators. They were in the weeds. They were doing something unique to really drive value. So they didn't care as much about interest rates, the economy, what somebody else might think their properties are worth. But generally speaking, very, very surprising just how bearish everybody was. I think the wealthy people, the big time players, the $100 million a year acquirers, almost universally bearish. They're in wealth preservation mode. They're already rich. They've been rich for a while. They've seen a lot of time, and they know that it can't go on forever. And they think asset prices are going to drop. They're fixing debt. They're worried about the future, and they're ready to buy if things get cheaper. I think the folks who got wealthy recently, more bullish, or the people who haven't made the money yet, more bullish. And to be honest, if you don't have generational wealth and you're not trying to protect generational wealth, it doesn't necessarily make sense to be too stressed about interest rates in the market right now. You're out there trying to get yours, trying to do deals. I hope that some of these people don't get burned if the market really takes a big hit. One very interesting note while at the conference was that I spoke to a big player who you all know if you're on Twitter, and he in private told me that it's the first time in 5 years that they've struggled to complete a raise of capital. So we all hear interest rates, we all hear the Fed, we all hear banks, we all hear that borrowing's getting more expensive, so cap rates have to widen, property has to get cheaper. But we haven't yet heard that capital, the equity side, has been harder to get. We raised on a $9 million deal, one of the biggest deals we've ever acquired. We raised $6 million of equity in about 2 days, about a month ago. This was a deal that's been under contract for a while. It's a good deal. It's one we're excited about, but it's just about to close. Actually, it closed last week. It closed last Wednesday. But this deal raised very quickly. We raised it faster than ever. Maybe it's just because my machine's growing and we haven't had a lot of deals, but we had no trouble raising $5 or $6 million pretty quickly. Now, this other operator, bigger than me, much bigger, was looking at an 18 or 30. I can't remember if it was either 20 or $30 million equity slug for an acquisition, and they really struggled. The last $5 million they had to give better terms to one group to come in to take it down, and that's a very interesting data point, because when that starts to happen, when equity starts to get hard to come by, it's the early signs that, holy shit, the market really could crumble. One of our acquisitions guys quit this week. Hasn't gotten enough deals. Tough market ahead. Want to take another opportunity. We're hoping that others don't do the same. But we sense a shift. I sense a shift. I'm at Reconvene. Everybody's negative. A lot of people are either not buying at all or they're literally backing out of deals that are under contract. The brokers are calling me. We had a deal listed for $7.75 million by a top broker in the area, a friend of ours. We instantly responded. This was a month and a half ago. We responded and said, hey, we're probably in the $5.5 million range. This is a $7.5 million deal. We're in the $5.5 million range. And they instantly responded and said, okay, we'll let you know if pricing expectations relax, but that's definitely not going to get it done. Well, last week they reached out and said, hey, Nick, we think you should submit, 5.5. I think the owner, it'd be worthwhile to submit. And we said, hey man, we're not there anymore. We're at 4.5 now. And they said, well, we still think you should submit. And we submitted the offer. We don't know what's going to happen. But of the last 10 big portfolio listings that we've seen, I don't know that any of them have traded. I don't know for sure. I know that 3 big ones did not trade, meaning they got listed by the brokers. Pricing expectations that the brokers had given the sellers were nowhere near reality of what the market showed. So they literally did not trade. Brokers are calling us. Our acquisitions folks are actually getting sellers who are a bit more realistic on pricing, and the dominoes are tumbling. Am I afraid right now? I think always a little bit. I mean, my partner and I made a lot of money over the past 2 years. We've built, if things hold on, generational wealth. I raised $35 million of outside capital over the past 2 years, possibly more. Of course, it's nerve-wracking when so much uncertainty and so much change happens so fast. I could be right now navigating a 2008-ish crisis for real estate. We don't know. But I'm tasked with making those decisions, and it is hard out there. It is not easy. I'm tasked with making the decisions on locking in debt, whether or not to lock it in, at what rate, what terms, what prepay, what flexibility, what we can buy, how much we can pay for new real estate, what terms we're offering our LPs, how aggressive we are when acquiring, what type of bank debt to go after for new acquisitions, when to refinance. Tons of very big decisions with drastic financial implications are put on my shoulders as the leader of the company. And I'd be lying to you if I said that it wasn't nerve-wracking and hard. I think one thing that's very different is that last year at this conference, I was one of those, new investor bulls. I was one of the guys who, oh my gosh, this is amazing. This is America. Let's go. Let's buy storage. And this year, I think I've shifted already to the protection of wealth. It sounds crazy, but my job right now is to not lose money for me and my investors. We're still buying. We got great deals in the pipeline. Well, one deal under contract. We just closed a couple of great deals that we had in our pipeline, but we are still underwriting a ton of deals. We are still investing in our team. So it's really a shift that I've seen in myself, and me being less risk tolerant, me being, more interested in protecting the downside is something that I'm pretty glad was a mindset shift 6 months ago. I'm really glad that 6 months ago, me and my team and Kevin decided that we're not going to overpay for storage and we're going to be really, really disciplined. And okay, yeah, we want to buy $100 million this year, but guess what? That could expose us to drastic risk. So I'm glad that we've been disciplined. This week is very scary. We will see what happens, but I feel the tide turning. I feel deals coming. I feel sellers' expectations relaxing. I think things are about to shift in our favor, and we're about to be able to buy storage at a really, really good price. And that's exciting to me because we haven't been able to touch pricing expectations in 6 months. So I hope that everybody out there is okay, but I know that the folks that are highly levered with floating debt are going to be in some trouble. Even if interest rates stay right here for 2 years, there will be a real estate crisis. Do you really see them going down? I don't know. Maybe, of course, potentially, but it could just be getting crazy, and I'm here for it. I spend a lot of time thinking about how to manage risks. I spend a lot of time thinking about what could go wrong, because my investors don't pay me the big bucks to be a bull and just ride the tide that floats all ships. They pay me to make sure that I don't lose their money. And that is a totally different mindset than I had 2-3 years ago before I was raising outside capital. And we're in a good spot. All of our debt is locked. Our properties are performing. We don't have any of them that are underperforming projections. We feel really good about stuff right now. So I know that this will create some opportunities. I know it'll create some pain as well. And it's an interesting time. This conference just kind of exemplified that it's risky out there, it's stressful out there, and everybody's a little bit scared or a lot scared. Everybody in the market is. All the syndicators, all the investors are pretty scared. So take that as I'm not a genius. I don't know what's going to happen. I'm not sure. Take that as just one piece of the advice puzzle that you get. Talk to a lot of smart people. Make the best decision that you can. And good luck out there.
Juniper Square, the sponsor of this show, recently conducted some research to help you understand what real estate investment managers are doing to build stronger relationships with their investors and earn more referrals to new investors. Their new special report includes data on topics such as what factors are the most important for building investment relationships today, how technology is being used to provide a competitive edge, and the one technology integration that is driving more repeat investors and more referrals. To download this for free, visit junipersquareresearch.com. Again, to get this report for free, visit junipersquareresearch.com. Before you go, we have a new sponsor of the show, RE-convene.com. And if you bought a piece of real estate, you need to get a cost segregation study done. It's what allows you to get all that sweet, sweet bonus depreciation, and it's how real estate investors like me and many others pay almost nothing in taxes on an annual basis. You can cost seg a single-family rental, a short-term rental, or a large commercial property. REcostseg.com is affordable and aggressive and super fast to turn them around. They've done 10 plus cost segs for me this year. They're going to do many more for me. Visit REcostseg.com to learn more.